How did one trader make almost 40 million in just 5 months with a couple of positions? Well, in this episode of Systematic Shenanigans, we're going to be breaking down the controversial strength that's helped multiple traders scale from small account to 8 and even 9 figures. After analyzing their performance, Padma and I have identified the common thread that separates these incredibly successful traders from regular traders. We'll be discussing how concentrated bets can make or break your trading, and a couple of other techniques. Let's get straight into this episode. A trader made almost 40 million in the last 5 months, and Pedro and me are going to go over one of the key traits, at least we've identified that we think he's kind of taking on and playing in a really strong side. It also correlates to a lot of the other really big traders that are somewhat well known, at least on Twitter. So I'm going to let Padma take off with it because I think he's studied it a bit more than me.
Yeah, so to give a little bit of the background story, this guy's called James Wynn on Twitter, and all of this information is public. You can see from his public wallets because he's trading crypto and he's swinging massive size on his wallet, and everything is public. Whether he's hedging on centralized exchanges or not is a discussion that you can have, but the reality is that he made 40 millions on that position, and that's all public. And one of the key traits that he has been, and this is something that any professional in this space or anyone that does risk management professionally or even a normal trader will say that is irresponsible, is that they put a lot of size into one single bet, and that was Bitcoin. I think his position as the day that we are talking right now, I saw that it was around $400 million in one single trade. And so, yeah, that is a massive position. And from a risk perspective, it's pretty responsible because you don't really know how much, if you had complete certainty about a certain outcome, let's say in Bitcoin, you would know that it would go up no matter what. You would want to bet the farm. You would want to do what he's doing. In the other side, you don't really know if you can have positive expectancy into the future, right? Your signals could be positive and you could have a real edge. But there's variance and noise, and you don't really know when you're right or wrong. And putting your entire portfolio behind a single bet is always irresponsible. On the other side, and I think that Munir will get into this more detailed, is all the people that I know that have grown small accounts into very large accounts, all of them did through concentrated bets. Like, you ain't going to get from a few $1,000s in your portfolio into millions or even 8 figures and 9 figures by doing possibly sensible management, trying to target the 30 to 40% annualized volatility, making 20 to 40% annualized returns. You ain't doing that, at least not until you are old, you know. And so there's both arguments that I don't like to dismiss. On one side, you're probably going to blow up your account if you do a lot of concentrated bets, or you get lucky and you build a really big account. What do you think, Munir?
Yeah, I pretty much agree. I think all the biggest traders we know had to make a concentrated bet at some point. There are a couple of traders to say that they have still, got an amazing P&L, but often they are half or even lower compared to the size of, people that got. It's hard to say if it's lucky, because obviously we both agree that taking a huge concentrated bet on really any position often, unless your certainty is like 100% like the billions show, it's a very difficult thing to do, and most of the time isn't actually plus EV, because if you did it 100 times you'd probably end up blowing up your account most of the time. To give at least a couple of more examples is Eternal Envy on Twitter. He's huge size in small cap shorting. Now, I don't know too much about his strategy, but primarily I know it's around shorting small caps to some sort of filters. And the most incredible thing about him is, at least from the size he shows on Twitter, he is probably using a very high percentage of his account on each position. And he's probably risking quite a lot as well, because his P&L swings, I think recently he finally hit 8 figures. I think he was at 10 million, and then it was like a week later he was back at like 8 or like 7 almost, which is an insane 3 million P&L swing in a week, which means he's obviously taking very large size. But that's also how he's able to scale. I can't remember what his original account value was, but it was definitely, I think it was below 6 figures, I assume. was around 6 figures. And then to scale that all the way to 8 figures, that's an insane return, especially not it being in crypto or getting lucky on one single position, but swinging very large size in one particular market niche like small cap shorting. Another example, obviously, is Lucas. Lucas basically did the same thing back in 2020. Now, obviously, he was around small cap shorting, and now he's scaled into different sort of markets and where he's made a lot of P&L as well. But I know a lot of his original account compounding was definitely from small caps. Then we had James Wynn, which kind of Pedma just went over. And then a more obscure one that I think is a bit more realistic was Trader Bryce. I think he was on Stocks to Trade, and I followed him a while back, and he made, I believe it was like 1 million, maybe 1.5 million, and it was primarily all just OTC breakouts. And then I think it was a couple of Nasdaq breakouts as well. But it's the same sort of topic of being either a concentrated bet, meaning that you're on a single position or a single sort of thing like that, or in a single market niche where you compound extremely heavily on that particular strategy, and that's how you get those outsized gains. For if I think it's a good approach or not, for me personally, I don't do that approach because I don't like taking on that much risk. Like I still have bills and stuff like that to pay, and I have people to take care of. So I don't think I can be as politely said kind of like reckless in some essence. But if you had enough capital where you're very solid, maybe you have, a couple of years of savings, or you have your house paid off, all those sort of things, then yes, I think it's actually sort of plus EV to take large bets like that, because you can dramatically change your wealth based on if you actually found a particular niche where, yes, it's high volatility, yes, it's high risk, it's also very difficult to hold and execute, but if you can, you could get 10x, 100x multiple on what you're actually trading. So it depends on the situation you're in. I don't think most newer traders should do it. Most of the time, they won't actually identify the right niche. Maybe if you've been trading for a bit and you actually understand that there's a particular edge here, or there's a concentrated bet you can take, then it could be worth it if you have kind of everything else sorted out. I don't know. Do you sort of agree?
Yeah, definitely. I do think for most people that don't have an edge, don't how can I say, don't understand how market works, they should trade small and try to compound their accounts slowly. And if you sometimes hit like a really interesting trade that something is mispriced and you are willing to take enormous risk for it, I respect it, at least. I'm not saying that it is a viable solution. I will say that I respect it. For example, we have not to brag on it or whatever, but it's just a real life example. You have my hype trade, the Hyperliquid one. So I got an airdrop back in November last year, and at the time, if I'm not mistaken, it was around 20% of my portfolio that I got as airdrop. If I'm not mistaken, it was around those values. I knew that company token, whatever, was mispriced. I knew that they were generating too much revenue for the price that they were at, the market capitalization that they were at the time, and I was willing to roll the dice. And it eventually 3x or 4x my total net worth, not just my portfolio. And that was a massive concentrated bet that I still hold to this day. And yeah, I know in for the past 6 months, 7 months, it has added a lot of volatility to my portfolio. Maybe one day I'll reveal the numbers publicly, but right now I don't. And but I can say that it is a massive contributor of volatility. But at the same time, it was a bet that I knew. I wasn't sure of it, because you can never be 100% sure. Things can be hacked. The protocol can fail their promises. A bunch of things. There's so many risks involved, but that's why there's the risk premium there that we talk so much about it. Like, I knew that it was mispriced, so I was willing to swing size on it. I added even more over time, and it paid off. And it's like, it's so hard for me to say if it is a good approach or not, because at one side, I prefer the safety approach. And on the other side, I'm thinking of myself as a young guy, like with a few $1,000s in my bank account. How am I going to compound that into a livable income? It won't be by being smart, quote unquote, about my risk, or taking the professional approach. It will be by taking massive concentrated positions and getting lucky on variance, because you could catch like a multi-year drawdown on a system and you just blow your account doing that. On the other side, other people caught a good wins on the market and got rewarded for it. So there's a lot of variance in luck when you do that. And it is what it is. You just got to be willing to roll the dice, basically. It's very situation dependent, like you said.
Yeah, I agree. I think it's also I'll see if I can leave in the description the book that I read ages ago about it. I don't know if you read one as well. It was something about there's like different types of luck and how you can kind of create your own luck. And a lot of it is about being in the game long enough, being exposed, being curious, and also putting in obviously a lot of work as well. So I think you can take concentrated bets, but I don't think you should actively be trigger happy with concentrated bets.
Yeah.
In my opinion, it's like you have to be at it for a very long time. And a really easy example, actually, recently, I wish I'd put more size behind it, but I had just other things going on in life. But like the SPY, dropping about, I think it was like 19-20%. That is a maybe not once in a decade. It probably will drop another time soon, but that's a very high opportunity scenario that where you could have actually deployed quite a lot of capital, and if you had the
Yeah.
right read on that concentrated bet, you could have made really solid money, because SPY went up almost 20% since then, and if you put some leverage on that as well, it's a crazy good bet. Now obviously you don't want to probably put 100% of your portfolio in that, but if you've been around long enough, I was able to put, I guess, what would that be, like a 5% of my portfolio into it, and I was able to do very well on it.
Yeah.
And that's like one of those scenarios where you can do really good.
And sorry to interrupt you, but quick note for the listeners. All of this was said on the podcast as the events were happening. Both me and Munir did take the positions and they are publicly available.
Yeah, it's one of our braggy part. It's one part I kind of like about doing this podcast, because obviously there's been things we've been wrong about as well, and necessarily we're not taking discretionary trades every single time. But it's really cool to look back and be like, oh, we were thinking this at this particular moment. This is what we wanted to do, and then these were kind of the actions we took as well. And I do kind of love that from starting this podcast.
Yeah, for sure. It's like we are wrong a ton. Like we are wrong a ton, but we are not like bench analysts here. We are actually putting cash and serious cash of our own portfolios into our bets. And yeah, it's like Munir said, is we are not taking like these more discretionary plays every day, because we are systematic traders. But when they come, we are not afraid of taking them. When there's a very obvious, at least obvious to us, we could be wrong again. When there's a very obvious opportunity, me and Munir will take size on it. And that's, in my opinion, that has been a major contributor of PNL for both of us.
100%. I think also one sort of adjacent topic to this is a lot of people say, how much should I be risking? How much should I be compounding of my account? How much percentage should I be using of my account? And I always find that question a bit difficult to either answer or address, because it really depends on your risk appetite. Like, I'm a lot more conservative than Pedma, but we still take on risks that he'll just probably maybe take on 1.5 times my risk, for a particular position if he's concentrated on. Where there is other times, though, some positions I'm more excited about, or I know more about, and I take a larger size than him. So it really depends on the particular strategy. It depends on the particular bet, and then a lot of those things then can make a good decision of how much portfolio size you should be using on one. I will say, as a very basic rule of thumb, ideally you should use about 1%, but there will be some bets where you want to put on more, or some strategies where you can size it up more. So for some of my algorithmic strategies, I normally scale them up quite smallly. So I'll start them with like 10% of what they should be at, and then I'll slowly scale them up as performance continues and I get more sample size. And then if it's a strategy is working really well, if it's in a really good market environment as well, then maybe I'll continue to up the size more. You can also use things like Kelly criterion. I'm not the hugest fan of it, because I think most of the time you could just use a percentage and it would be basically the same. But you can use other mathematical ways of that as well to kind of do position sizing.
Yeah, definitely. If you're going to use the Kelly criteria, you should use a fraction, like the half Kelly, so that you don't blow your account. There's a tweet from Systematic Long Short. I'd like to read it, because
Sure.
it's really like on point with our concentrated risk. So he said like this: if you knew with certainty, like probability of 1, how the stock of a price of a single instrument will move tomorrow, the rational, optimal thing to do is to borrow every outlet you can and bet the farm, house, and tomorrow's farm and house it. The more certain you are, the less you want to dilute that alpha. Even in the context of having 2 stocks with probability of 1, you would just pick the one with the highest absolute returns. In cases of complete information, there's no need for diversification. However, when P is small, diversification becomes the only free lunch. Noise gets averaged to 0, variance decreases, and what little signal you have converges into something meaningful. From a capital allocation standpoint, multi-manager pods with built-in diversification and pass-through fees versus single theme, single industry boutiques funds for separation of return streams exposures. So what this is saying here is, in terms of the question for concentrated bets, if you understand that something is very likely to occur, or on a hypothetical scenario that doesn't exist, it's 100% certain, you would want to bet the farm on that because you will get it. So you want to borrow anything you have and bet on it. But the thing is, markets and the edges on markets are usually very small. You have a very small fraction of probability that something will occur. So the diversification in this case allows you to dilute any noise that you get on your signal. For example, you get this noise, to be briefly like explain, is like, imagine that today I have $100 million running lying around and I want to buy $100 million worth of whatever, of Peloton stock. Okay, that will affect the market probably on the day, and you might get a signal, and that signal is noise. It's just me randomly purchasing, like, at whatever price, $100 million of stock, and that's noise. So when you diversify a lot of positions into a bunch of stocks, you eliminate that noise and also the low probability of the outcome. So it's like, it's really hard to say if you should. I don't like to give this sort of advice. Should diversify, you should be concentrated. It's really dependent, like we were saying, whatever is your situation and willingness for risk.
Yeah, I agree. I think also that's why, while studying accounting was very boring, I still love it to this day because I like thinking in all those different kind of forms of like what is best for budgeting. Because this is going to sound a bit weird, but in some essence, when you do accounting, you can optimize for different things, right? Some people are going to optimize for taxes. Some people are going to optimize for how much they're putting in R&D. That also optimizes in taxes. All those different ways you can do it. And at the end goal, you need to know what you're optimizing for. What is your baseline? You know, what are you most willing to put on the table for it? And it's very similar in trading when you're taking on risk, because some people want to be more conservative. Like I know lots of traders that have, you know, a very significant proportion of their net worth in their trading account. Whereas for me, I don't like doing that. Maybe I'll have 20, 30%, but I don't want to have 100% of my net worth in one trading account. Whereas I know a lot of crypto guys, not specifically you, but I actually met one recently in Dubai. He had, I think it was about 600 grand in meme coins in his account, and he only had like 10 grand in his bank account. That's insane. Like I couldn't do that. I would die on the spot. But for him, he was walking around fine. He was chilling. He was laughing about everything. You know, it was his way of taking on risk. So you'll need to understand what sort of risk tolerance you have, and that will take time. I don't think I really understood my risk until maybe 2 years in. I was kind of consistently adapted. I think the first year in, I thought I was going to try and risk everything. I was just putting any money I have to try and see if I could make it trading. But afterwards, I got a bit more educated, and then I think from there you can do really good. And one last point: be sure to follow, what's his actual tag? It's just systematic CLS or systematic long short.
Exactly,
Banging tweets.
systematic LS.
Yeah, very good tweets recently, man. He's been really putting some out.
Yeah, these guys are more professionally graded, and they really think through these issues. And it's I really enjoy the way that he puts things. I also highly recommend like following it.
Yeah. What I actually want to steal one of your topics, or at least I just want to start it, was you put pain as the path to victory in markets and in life. And I was recently watching a podcast and someone put something very eloquently. I'll probably ruin it a bit, but now please have some common sense. This won't apply to everything in life, but he was primarily saying that if something was painful in the short term, it was probably plus EV in the long term. And I think so much of that is kind of true. Like recently, I've been on a diet and short term, it sucks. But I know long term, it will be better for me. And there's just so many other things like that. When we took the SPY position, I knew being in drawdown, you know, by whatever 5-10% sucked. But I knew probably in the long term, this position I felt very confident with. And then obviously it's been plus EV now. And there's a lot of things like that. Being into trading for the first 1 to 2 years sucked. It was obsessed with trading, but objectively I was quite unhappy because of trading was very difficult. But you know, now almost 6 years later, it's one of the main things of life, and I can't go really a day or two without talking about trading with either you or someone else. It's just like a part of my kind of life now.
Yeah, exactly. I do think there's. I completely agree with you. I think there's some nuance though. Like for example, if you were buying like Luna, you know, and it was crashing and crashing, it was painful, and it was just going to be more painful. So you need some edge there. But in terms of that, I've never, my best positions, my best trades ever were the most uncomfortable trades you have to go through. Like going through the 2022 drawdown, crypto drawdown, seeing everything go down, all the way down, liquidity drying up, like FTX blowing up. You see, even on Joe Rogan podcast, people were talking there how crypto was like a bubble that was never going to go back after this. Like that was extremely painful to be in the space. I could have easily pivoted to stocks or something like that, and I just stuck with it and dig even deeper into it and explored project and if I did change, I wouldn't be here where I am right now. So um, it but at the same time it took some luck. Like it could have been just a bubble, but it took some luck and some like edge, I would say, like in exploring different markets and understanding what is like the potential long term of this sector. So it's a mix of experience and the willingness to take pain and risk, in my opinion.
Yeah, no, I definitely agree. I think the conversation of nuance, when I first started writing stuff online, I was very scared of nuance. I always wanted to put all nuance I could in one particular part of a question or whatever if I was writing a tweet. Over time, I am more of the phase that people that view the tweet or the writing, as long as there's, okay nuance, it's impossible to fit 100% of nuance into any quote or anything really. Most of the time, what I've noticed is the people that are worth speaking to or talking to about stuff, they'll normally understand that there is nuance or there are always downsides to something. Like my favorite quote still is everything has opportunity cost by Jim Simons, because I always think it's true. Anything you do in life, it's like the saying of grass is never greener on the other side. Most things are going to have something you didn't foresee that's going to be uncomfortable, that's something you're not going to be able to like, and you need to pick what con you prefer to kind of live with. And that's the same with risk. You can be really head on with risk and take 50% of your portfolio on one particular trade, and then you'll have to suffer through a lot of volatility and the realization you could lose 50%, or you could double your account in one particular day as well. So you have that sort of cons on both sides.
It's like people when they say, "Hey, damn, you made so much money this month." Yeah, but you didn't see that I was down 40% for the last 6 months. You know,
Yeah, yeah,
the grass is always greener. It's like in trading, in every business. Like even for example, the small cap guys. We that do trend following or momentum systems. At least I'll talk for myself. Like I sometimes see these P&L graphs from some of these guys so linear on the way up. First of all, let's assume that they show everything. But on the other side, you could like those type of strategies are always at the risk of having a super large loss. And you see the real guys that are swinging size on small caps, they sometimes have a massive loss out of nowhere, and that's expected. That's a negative skewed type of system, right? You make a lot of small wins or decent wins over time, but you always have that like left curve, left tail risk of a massive blow up out of nowhere. So there's no perfect situation. There's always risks and what is the name, like trade-offs that you have to do for any business, any trading strategy, whatever.
yeah. No, I agree. I think it's one point around it is I recommend everyone does a decent amount of backtesting for one reason, that it can show you a lot and teach you a lot about if you view someone's equity curve. Because as you're kind of saying, when I view someone's equity curve, if it's basically linear upwards, they're taking on some sort of hidden risk, I guess. Let's say whether it be a high win rate strategy that could blow up because of one particular trade, like they're using a very wide stop, but it just takes one of those trades at one of those times to move 300%, and then they've blown up the whole capital. So like always, when you look at different things, or if I look at your equity curve, it's pretty clear that you're running trend following, because you'll have drawdowns for extended period of times, and then you'll really recoup. You'll have a great kind of all-time high break, and then you'll go back into drawdown for a bit, and that makes complete sense for what you're trading. So I think if you educate yourself on strategy types and understanding how they work, what's their optimum, I think it's a really good way of viewing other people's performance as well.
Yeah, definitely. There's always there's always trade-offs. I've done that dance, like looking at others and always wondering, well, maybe I could be doing that, maybe I could be in that business instead, or whatever. It's always trade-offs. It's never something. It is sure. There's some businesses that are better than others. Like I would assume that cleaning sewers, like a business of cleaning sewers, is worse technically and to maintain than like I don't know, like a restaurant. Maybe it isn't, but let's say that it is. Like there's better and worse, but there's always risks, and operational, like hard things to do. So never feel like you have to change because something is better. When you're starting out and you don't have an edge, definitely experiment and see what fits your personality best. But once you have something locked in and you actually make money with it and make decent returns, don't throw it away for nothing, man. Don't trust me. It generally doesn't work. Become an expert in something, run it at capacity. That's what I did.